Welcome to the Prosperity Health GP series. As accountants and financial advisors who specialise in the medical industry, we know that our clients are often time poor and find it difficult to make themselves available during office hours. So for this reason, we've put together this short series of videos which address some of the key questions we get from our GP clients to help them run their practices better and also control their personal wealth. In this video, we'll be looking at the subject of when it's appropriate to start your own self-managed super fund. So Gary, can you give us an outline, first of all, of the different kinds of super funds that are available within the Australian industry?
So there's basically three main types of super funds available in the Australian marketplace. Firstly, we have retail super funds. So retail super funds are generally run by large banking and financial institutions. They offer members a range of investment options and insurance choices. You can invest into usually managed funds, direct shares, and the fees in retail funds generally range from about 0.5% to 2% per annum, depending on the investment choices you make. Secondly, we've got industry super funds. So industry super funds are set up for employees in a particular industry. So for example, in the health industry, we have the HESTA fund. Industry super funds generally have a more limited range of investments and insurance choices. However, the fees tend to be lower in industry super funds, ranging from about 0.5% to 1.5% per annum. And then thirdly, we've got self-managed super funds. So they're set up by individuals in the form of a trust structure. They're limited to 4 members. And self-managed super funds are regulated by the Australian Taxation Office, whereas industry and retail funds are regulated through APRA. With self-managed super funds, for them to be worthwhile, you generally need to have assets of around about $300,000 to $400,000 in the fund. This is because there's additional costs in running a self-managed super fund, which the fees on those can range from around $3,000 to $8,000 per annum.
Okay, so it sounds like at some point in the life cycle of a GP, a self-managed super fund is going to be of interest. Can you tell me what the main advantages of a self-managed fund would be?
So firstly, the first main advantage is a bit more choice around where you want to invest your assets. So a self-managed super fund can invest into residential property as long as that property is tenanted to an independent third party. It can't be rented out to family and friends. Self-managed super funds can also invest into business property. So for example, a medical practitioner could buy the business premises, which is running the medical practice out of. There can be some long-term tax advantages of owning a business property in super, just due to the fact that superannuation is a concessionally taxed environment and generally you pay only 15% tax on the income. And then the other investments that self-managed super funds can go into include direct shares, a range of managed funds, and also cash and term deposit investments. Secondly, self-managed super funds have a lot more flexibility when it comes to setting up pensions. So for example, when we get into our late 50s, early 60s, setting up a pension can be a big advantage from a tax perspective in that the super fund no longer pays tax on the investment earnings. This strategy is much easier to set up in a self-managed fund as you don't need to sell down assets to commence the strategy. Self-managed funds also have the advantage of greater control over investments. So for example, they're not restricted to a specific investment menu like an industry and retail fund is. And also, you're able to pool your assets into one consolidated investment strategy. So if you had a husband and wife in the self-managed fund, they're able to combine their assets into one strategy. Self-managed super funds also can own insurance policies. So for example, they can own life insurance, total and permanent disablement insurance, and also income protection insurance policies. And they have the flexibility of going to the entire market as far as a choice of what policy the members want to own. And the final advantage, I think, is from an estate planning point of view. Self-managed super funds can actually have a built-in will within the fund where fund members can actually accurately distribute lump sum and pension benefits to beneficiaries.
Right. Okay, so one of the common questions I get from clients with the self-managed fund is whether they can borrow to buy either a residential property or maybe the the practice premises. Could you explain what restrictions there might be around borrowing within a self-managed super fund?
Yeah. So self-managed super funds, yes, so they can borrow to purchase residential and also business property. Basically, the fund is the beneficial owner of the property. However, to begin with, there's a trust structure that's set up, which is actually the legal owner of the asset. And over time, as the self-managed super fund pays down the loan, then it eventually becomes the legal owner of the asset. However, during that time that the fund's paying down the loan, it does receive all the investment income from the asset. So this can be a long-term advantage of owning a property in the super fund. If you don't have sufficient capital to purchase it outright at the beginning, you can use borrowing to help acquire the asset. Good.
So are there some disadvantages to running a self-managed super fund?
Yeah, look, probably the two main disadvantages are firstly, the ongoing compliance obligations on the trustees of a fund. So each year, fund trustees are required to basically prepare a set of accounts and lodge a tax return with the Australian Taxation Office. Trustees need to have an audit done for the super fund each year. All decisions made within the self-managed super fund have to be recorded and minuted. So there can be quite strict penalties from the Australian Taxation Office if trustees don't meet these ongoing compliance obligations. And I guess secondly, there's the cost of running a self-managed fund. So you've got the additional accounting and financial costs of running it. So you just need to make sure that there's sufficient assets in the fund to justify that cost.
Okay, so when you put all that information together and you're meeting with a GP, what would you say are the key criteria that you'd say would be the tipping point for when they'd consider a self-managed super fund?
Yeah, I think firstly, if you come to the point where you really want to have more control over your investments, that's a good reason for a self-managed fund. Secondly, making sure that you've got sufficient assets, as I said, that $300,000 to $400,000 in assets. And thirdly, if you're looking to purchase a particular asset, such as a property or a business property which can't be bought through another superannuation vehicle.
So I'm sure you'd agree, Gary, that it's important to note that the advice you've been giving in this video is of a general nature only, and that it's very important that if you're considering investing in a self-managed super fund, that you speak to your financial advisor about that subject. So we hope you've enjoyed this GP video on the subject of self-managed super funds. If you'd like to find out more about the other videos that we have in our series, please go to our website at prosperityhealth.com.au, where you'll also find contact details if you wish to speak to one of our team.